Welcome to Opal's TV. Today I am in South Africa together with Mark Witten. He's Managing Director of Johannesburg-based Kaizen Asset Management. Mark, give us a brief background about yourself and introduce your company.
Thanks, Matthias. So basically, Kaizen Asset Management, which is a Johannesburg-based multi-strat hedge fund, was started by myself and my partner in 2010. It's basically a multi-strat fund that invests across all asset classes, and we believe in a multi-modal approach rather than just being fixated on fundamental stock analysis or macro or technical. We have a multi-modal approach that looks at all different tools across all asset classes. The reason being is that my career has progressed through various asset managers, from the long only through to the hedge. I started in RMB Asset Management in 1999 on their grad program. I spent 2 years there and then moved to London, where I worked at Goldman Sachs on the private wealth desk for 2 years. I did some studying at London School of Economics, did some backpacking and grew a long beard. And then I moved to Cape Town, to the waterfront, where I did an MBA at UCT. And I used the MBA to drop a business plan for Kaizen. And at the same time, I did my dissertation on all the hedge fund strategies that were available globally and what would work in South Africa. There's only 2 or 3 strategies that work locally. On the back of that, I started at Peregrine Capital, which is the oldest, at the time, it was the oldest and biggest hedge fund in the country, where I understudied the MD there and basically was responsible for the infrastructure and construction sectors, which at that point in time in 2006, South Africa was going through an infrastructure boom with the World Cup in 2010 approaching. After 2 years, I left with one of the directors and we started a company called Silk Road Fund Managers, which was very much more a momentum trading based hedge fund. And then after a year there, I left to start Kaizen in 2010. The reason why I basically chose the name Kaizen, it's also part of your biography in this business is very much your destiny. And Kaizen literally means constant and never-ending improvement, but also never becoming rigid in a way of thinking. Never saying, we're only bottom-up fundamental stock pickers. All these businesses, from RMB, which was top-down, macro-driven, through Goldman Sachs, which is more management-focused, use their brand to meet management, through Peregrine, which is bottom-up, fundamental, stock-driven, and then Silk Road had more of a trading, momentum trading type focus. It made me realize that, in every sort of market circumstance, there's certain tools that apply. And even though you might be the best stock pickers in the world, when there's a big macro event like the Lehman's collapse, the earnings multiples go out the window and basically the macro takes over as panic comes through to the market. Conversely, even if you choose the right industry, if you had chosen the retail industry in South Africa over the last 4 to 5 years, you would have done pretty well. But within that space, certain counters have performed much better than others. So we combine macro research with industry analysis that helps us to identify a universe of companies that we'd like to invest in. And one of the biggest constraints to our mandate is liquidity. We don't trade in anything outside of the top 60. We don't believe in holding positions in companies or securities that we can't trade out of in less than 1 day without being 20% of the market volume. So we tend to run slightly higher exposures, slightly higher gearing. But that being said, we also pay quite a bit away for insurance. So we tend to hold a lot of out-of-the-money puts, which act as a trailing stop loss. And therefore, for us, volatility is not risk. Volatility is opportunity to buy things that we like or to trade the market. We like volatility, we embrace it. So we're not concerned with a 3 or 5 or 7% drawdown in the market. What worries us is some event that causes a 25 to 30% drawdown. And that's why we tend to have these out-of-the-money puts that we roll up as and when the market rallies or monetize as the market falls. This unfortunately does result in paying away. It's like insurance is a grudge purchase. So we pay away quite a bit on insurance. But at the same time, we know that if the market comes off 20%, we shouldn't be down more than 5 to 7. Most hedge funds, and I can't talk globally, but I know most hedge funds in South Africa offer you 1/3 of the downside of the market for 2/3 of the upside. And what we say is take a little bit more risk, and we'll give you half the downside of the market, but we'll try cap your losses at 5%. It's obviously sometimes a moving target. We've been down as much as 8. Sometimes the market's been down 12 and we've only been down 3. Last year we had, even though the market was quite volatile and had months down as much as 5 to 6, we never had a down month. This year, we've had 1 or 2 instances where we've been down more than 5, but we also offer twice the upside of the market. So, if the market this year is up 7, we should be up 15, which is kind of where we are. Our target is around 35% per annum compounded. That's what we aim for. And obviously, we try to keep our volatility below the market. So we have a targeted vol below market volatility, but returns of twice the upside. That's kind of where we sit if you're looking to place us within a portfolio. Our core is long-short equity, but we are a multi-strat fund, so we do trade across commodities and currencies. And in the South African context, currency is probably the most important driver of the market. The correlation is very clear in that the biggest companies in South Africa are dual listed, so the prices are set in London and Switzerland, the likes of SAB Miller, British American, Anglos, Billies, etc. And our rand, if you take a look at it, has depreciated 70% over the last 3 to 3.5 years, and our market is up 70%. But if you look at our market in dollars, it's actually slightly down. So it's flat to slightly down, which is obviously not a good indication of South African earnings. We do split the fund up in terms of research versus portfolio construction, which is more my role, and then risk management, which we have an experienced derivatives trader who sits in the business. So the research function is driven by a guy called Giuseppe German, who has about 18 years experience. He comes from a corporate finance background, and we have 4 analysts, myself included as one of them, and we split the market up into the 4 sectors, being industrials, mostly globally diversified industrials. And then we have financials, which is what I cover. Giuseppe covers industrials. I cover the financials. Michael Homan covers the resources, the hard commodities and resources. And Stephanie Kaufman covers the soft commodities, food producers, and the retailers. And the way our process works, when I talk about being from macro down to micro, is we'll start at inception. So Stephanie will start with fertilizer and seed prices. She'll look at weather patterns to see, what's driving maize and wheat prices, etc. How that then filters into the food producers, who's extracting margin along the way. So for argument's sake, soft commodity prices have been falling, therefore food producers should benefit. How that's then passed on to the retailers and who's gaining market share, which segments of the market, the LSM segments are growing versus shrinking. So that's how we do our research, and research is very much focused on what to buy. Research the macro process drives the universe of companies we look at, and then research ranks. So it's irrelevant looking at a mining company versus a bank versus a tobacco business versus a retailer. They have different earnings visibility. What's important is to rank the retailers against the retailers. So the result of all of our research process, which includes coming up with an equity analysis document, building an earnings-based model, and then we rank these companies. We have metrics we look at that are important. For us, earnings, like headline earnings, are an accounting measure. It's almost irrelevant. What we do is we segment the businesses and we look at the drivers of those earnings. So for argument's sake, a company in South Africa most will know about is Woolworths. And Woolworths being a clothing and food retailer, also has an operation in Australia. So we would segment food, clothing and Australia, take a look at what we expect from an earnings point of view, but also from a cash flow generation point of view. And once we rank all these companies on these metrics like return on equity, free cash flow generation, leverage, stock turn, etc., becomes a lot clearer when you're comparing retailers with retailers over a 3 to 5 year period, what the momentum is, who's gaining market share, who's expanding margins, and who's on the decline. And that's kind of how the research process works in deciding what to buy. My role is definitely more on the portfolio construction side, where we look at when to buy it and how the portfolio should be positioned. We have a fundamental bucket, which is where everything passes through. There's 3 buckets in the fund: a fundamental, a trading, and an opportunities bucket. The fundamental bucket is very much deciding what to buy, but every counter or any investment we make goes through that fundamental process I've just spoken about. We therefore, after that fundamental process gives us a wish list of counters we would like to own, but at a certain price. And then we tend to start with around 5% of NAV as a position size. Once we've done enough research to justify a position, that goes up to 10. So at a maximum of 10% of NAV. Anything over 10% of NAV becomes a trading position, which is the second bucket. And the trading position is where our derivatives and currency overlays lie. The trading position is shorter term in focus, usually 1 to 3 months, whereas the fundamental positions have 12 to 18 months as an outlook. within that fundamental bucket, there's what we call 8 strategies, 8 mini portfolios, with retailers that Stephanie is looking after and food producers being one of them, resources being another one, commodities, actually physical commodities being another strategy, industrials is another part of the portfolio. It's a strategy, and each strategy is like a mini portfolio. So we'll decide, for argument's sake, on the retail space, whether we want to be long the consumer locally or neutral or short. Within that strategy, we'll have longs, and we'll have high conviction longs, and then obviously shorts. But the overall exposure is what I determine, the position sizing. So each strategy is broadly representative of the analyst's outlook for that sector, the companies they like versus don't like, but I'll decide on the position sizing and then how the portfolio is managed. So from my point of view, there's 3 levels of risk in the portfolio. The one is the macro risk, which is obviously when there's a major risk-off event that nobody can price, like a collapse of Lehman or when the Twin Towers collapsed, then everything tends to one. Currencies kind of collapse, all equities, good companies as well as bad, get sold off, and there's no real regard for value and quality. So that is where the portfolio puts the most liquid instrument in the South African market is the Aussie futures, the top 40 futures. So we have lots of out-of-the-money puts on these futures that tend to be a parachute. So for argument's sake, in last month's correction, the South African market dropped from peak to trough 12%. Our Aussie short, the protection in the form of puts, went from 30% of NAV to 80% of NAV without us touching the portfolio. So as the market fell, we started falling at a much less, much more decreasing rate. So we started flattening out our performance. That's the parachute we talk about in terms of that should minimize the risk. But you pay away for that. You're paying 1.5% to 2% per quarter of performance for that protection, which enables you to sleep, at night and to have a business around if the market corrects 30 to 40%. The second level of risk is between the major sectors, so the resources versus the industrials versus the financials. And these things tend to trade in tandem. So today Woolworths results out, they're not great. Woolworths is down 3%, but Shoprite's down the same. And the 2 businesses are not really all that related. One services the lower LSM segments, the others is much more of a pricing or a discretionary spend LSM segment, a 10 or above. If you take a view across South Africa at the moment, and I think it's a global story, but the resource sector for the year is down about 17 to 20%, whereas the financials and industrials are up between 9 and 10% for the year, and the blended result is 7% for the market. But if you were long resources and short the industrials, which looked overpriced, you would have been down close to 20% for the year, just as an example. And what happened in January is, there was an emerging market sell-off, and you had the resources holding up, gold going up quite a bit, local golds and platinum, and then the really high-quality companies that we like, companies with defensive balance sheets, visibility of earnings, strong management, sustainable earnings, and they pay dividends. Those were sold off as emerging market funds were forced to redeem. And you had this dislocation where the market itself was only down 3 or 4%, but really great companies that we like were down 20 to 30%, and the miners were holding up. And that was a great opportunity and that's the kind of opportunity that we like. It's, for us, when companies that are what we perceive to be higher quality businesses, and we tend to only gear these defensive businesses. Those are the positions we have higher conviction in. When those businesses become cheap, I always use this example. When I lived in London, whenever there was a sale at Harrods, the summer sale, people would sleep outside overnight to get their clothing at 70% discounts. When the markets go on sale, people run for the hills. There's panic and people run. Whereas the share price is the perception. There's a real business underlying that is still continuing to tick over. Whether Greece leaves the Eurozone, whether Russia brings the world to another Cold War, companies like British American Tobacco and SAB Miller, Unilever will sell more soap. These other companies will sell more of their product. All that's changed is the PE, which is a relative thing. It's a risk on, risk off tool. What we back, what we buy, are the fundamental underlying cash flows. When a business, because that's the only real thing that you can price. So we use 3 different valuation tools. We use the obvious PE and the dividends yield and the earnings metrics. But for us, a real driver of wealth creation in our business is the discounted free cash flow. Similar to a dividend discount model, but it's a free cash flow model. And then we look at also enterprise value to EBITDA, which is another big driver of where margins are going. So I think in a nutshell, that's kind of who Kaizen is, how our process works from macro down to micro, and then kind of how we view the world in terms of risk management. We're not a fund that has 30 or 40 long positions and 20 or 30 shorts. We have what we call our top 20 ideas, and in order for another idea to come into the fund, we tend to have to either reduce one of the ideas in the fund or kick it out altogether. So it's very much a culling of nature versus nurture. It's important that only the best stay in the fund, and we very much review on a quarterly, a monthly, but then a quarterly basis. We take a look at what hasn't worked out, how the macro drivers have changed, and do we need to cut. So we're quite ruthless with the actual position sizing, with the culling of bad ideas, and we're a big believer in letting your profits run and cutting your losses. If you've made a mistake, rather just take the pain and get out, rather than trying to justify it and trying to trade against the momentum. And I think we have a good combination of personalities within the business. My partner Ronnie Mazur, he seeded the business in 2010. I met him. He listed his business, Mazur Steel, in South Africa during the construction boom, and his background is he studied actuarial science. He was born in Israel, he grew up here, studied actuarial science, moved back to Israel for a while and traded currencies through Bank Leumi. He's got a very strong macro focus. Giuseppe, who runs research, is very much a Warren Buffett type deep value investor with a long-term time horizon. And then myself and Grant, who sit in the middle and run the portfolio from a portfolio construction, and Grant from a risk management point of view. We're more receptive to both. We try to balance the expectations, but we're more in tune with the market, with flows, with what's happening globally, etc. So I think it all comes together quite nicely. There's a lot of friction as well within the team, which is good, because I think it's important that iron sharpens iron. If there's just everybody having consensus all the time, or one personality that's stronger than the others, you tend to get a very one-sided view. So it's very good that there's challenge and debates and that sort of thing within a team. I think it's important to continuously question the what-if scenario, and our risk measurement is it's a lot broader, I think, than most hedge funds that I've worked with and been within, because we actually have 3 different tools that analyze risk. So we have a Riskura report, which is an independent service provider, and the Riskura report is quite, I don't want to say basic, but it gives you just basically your value at risk, your net exposures, your sector exposures, etc. But it doesn't really provide for scenario analysis. So on Bloomberg's, we run the port function where we upload our portfolio. It gets uploaded automatically, and obviously the derivatives need to be changed and loaded manually, the derivative overlays we have, and that gives you a bit of a scenario analysis, but that's an internal tool. So we've then basically got a consultant to come in and give us an independent tool, which gives us complete scenario analysis, where we can look at the market up 10 or down 10, oil prices up 10, or the rand moving, the Lehman's type scenario or the Greek crisis, etc. That gives us an identification. It's more a point of showing us where the risk lies in the fund, and then we can decide which risk do we consciously want to assume and which risk do we want to protect against. And obviously our slogan is, if you look at our newsletters, gain is commensurate with risk, and risk varies inversely with knowledge. So without risk, there's no reward. I can give you a portfolio with no risk, and then you must be willing to accept 6 to 7% a year. Conversely, I can give you a portfolio that is extremely volatile, but on a long enough timeline, I'll get you pretty much north of close to 40 to 50% returns. But you need to then be able to stomach 10 to 12% drawdowns, which most investors can't do. So we've kind of got something in the middle where it's our money is invested within the fund. We're not willing to accept 10 to 12% returns per annum compounded. We want 30% net of fees. Therefore, we're willing to assume a 5% drawdown on an annual basis in pursuit of 35% net of fees. So we're big believers in what Malcolm Gladwell calls the 10,000 hour rule. And if you've read the book Outliers, where he talks about, it's actually called the Hamburg effect, which is incidentally where my father's from, where he talks about, it takes 10,000 hours of practice before you become proficient in a skill. So be it music, or be it athletics, or be it law, or be it computer programming, in our case, be it investment analysis, each analyst needs to spend at least 10,000 hours looking at a sector, which is roughly 3 to 4 years, and that goes through a cycle before we can say we can trust their views on the sector. I think investment analysis is a science, and then you need to have another 10,000 hours of portfolio management, which is more of an art of blending investment views, liquidity, etc. together. And risk management is paramount to our process. You know, when I finished schooling in South Africa, I was my family owned restaurants, so I was a chef for a few years while I was studying. And you know, when you're running a restaurant, when you're a chef, first of all, there were two lessons. The one is that, like I said, earnings are irrelevant. It's how you manage your cash. If you buy too much inventory, you can't pay your rent and so on. So cash is always crucial to the core functioning of a business. But the second thing I learned was that if you don't have a recipe, if you're just putting things together, you might get an outcome, but you're not going to be able to replicate that. So it's important to be right for the right reasons, not the wrong ones. If you put together a recipe and then you try it and it doesn't work, you can figure out where the problem is, you can change and you can add to it and you can improve the product. And that's kind of how we see things at Kaizen. We have a process, there's a way to have a conversation, there's a way to put a trade on. These things are planned. We don't sort of walk in and see a counter down 5% and think, should we buy it? There's a way that we've got this counter. If we have an investment thesis that might be on our wish list, then we'll trade aggressively around our core positions. And that's pretty much, I think, the ABCs of the workings, the innermost workings and philosophy of Kaizen.
Mark, you said you target 30-35% with your fund net of fees. That's quite a high target. So how have you done?
Basically, we've targeted 35% compounded per annum, which we've achieved over the last 4 to 4.5 years. The first 6 months for us were reasonably difficult, as we were, trying to integrate the various views into the fund and learn to put together a fund. Obviously, the beginnings always have their teething problems. We were wrong-footed by QE2 in 2010 when the markets rallied and kept going, and we landed up being short the market. So we landed up 10 and then down 10. We landed up flat for the year. We went back to cash. We took a look at our macro themes, which were long the SA consumer, long global emerging markets versus short SA incorporated. And obviously we had a very bearish view on the rand, and that played out, added quite a bit to our performance. The third bucket in our fund, by the way, is an opportunities bucket, and it's where we put in ideas that we think are very interesting, where there's opportunities globally. And one of the positions in that was in that bucket was Tesla, which we bought at $56 and exited at $193. Right now we've got Alibaba in that bucket. We've had some really interesting positions there that have yielded us decent returns as well. 2011, the market was flat for the year, and we were up 25%, and that was because it was a very volatile market, where you had the likes of tsunamis in Japan and the Greeks threatening to exit the Eurozone, the S&P downgrading the States in September, which caused almost a 20% correction. And that for us is we really enjoyed that sort of volatility. It's where our puts come into the money, we're able to monetize our views, buy the stocks that we like and trade out of them. 2012, the market rallied initially, and then the Chinese came out saying that GDP expectations need to be low to 7.5%. And we started switching from being neutral commodities to being sort of almost short on the resources space. And that drove performance all the way through the year. We were flat-ish. In the middle of the year, we were up about 10 or 12%. But by the end of the year, we landed up 35% net of fees against a market that was up close to 20. 2013, I think, was the year that definitely defined us as we grew in assets under management. We started off the business with around 25 million rand in 2010. In 2011, we got it to about 50, 60 million rand. 2012, we got to just over 100 million rand. At the beginning of 2013, we were on just over 100 million. But then by the end of 2013, we were on 600 million. And most of that was, obviously there was a lot of performance in there, because that year we were up 57% net to fees. And that year, I think what defined us is that we started becoming a lot more confident in trading more aggressively. So we were more, we were capable of not taking bigger positions, but just trading around our core positions that we had very strong fundamental views on. And we also had identified, as you grow within something, you identify, you evolve and you adapt, and you get better identifying instruments that suit your philosophy, that have the liquidity that you desire, etc. We've obviously along the way, if you're looking to achieve these kind of returns, you need to accept a bit more risk, which means we'll have 5 to 8% drawdowns, particularly intra-month. And unfortunately, in this industry, you're judged on a monthly basis, which to me is fundamentals don't play out on a monthly basis or even quarterly. you've got to take a 6-month or 12-month rolling view as to how the fund is performing. So like I said, we try to offer twice the upside, and even this year, which has been a year of a lot of frustration in that the markets grind slowly higher as volatility's fallen, from, call it, February all the way through to June and July. But there's been no real conviction, there's been no real volumes, and we've been paying away protection, which is a big part of what's been a drag on performance. We were only up, call it 6 or 7%, and the market was up roughly the same in September. But in October, it gave us the volatility that we really enjoyed, the volatility we expected. And the market came off 12%, we were down 8% intra-month, although there was just a day or two of dislocation when the resi held and the financials and industrials fell further. And then when we cut some of our shorts and we're buying the businesses we liked, the market rallied back to almost flat for the month, from an 8% down, and we were up 9%, so we did double the upside once again. So for right now, for the year, we're probably up close to 15, the market's up 7. We fulfilled what we believe is our mandate in a very, very difficult environment. We continue to chase these outsized performances. We're not, as much as I appreciate that you need assets under management to build a business, we're definitely not chasing growth in AUM, we chase performance. So we'd rather have, less AUM, but we are looking for that 30 to 35% compounded per annum. That is our mandate. We prefer to think of ourselves as specialists rather than generalists.
Incorporating macro views are part of your portfolio construction process. Please share with us some of your views.
Three very strong prevailing macro themes at the moment. The first is that the US was first into this mess, into the global financial crisis. They've been the first out of it. They did the right thing with QE, with excess liquidity. Europe, unfortunately, went the austerity route because Europe is not unified the way the United States is. So right now you're seeing the result of that being an extremely strong dollar. The dollar is once again in a bull market. And if the dollar continues to rally, which it is, you see a decline in the price of commodities, and you see, there's been a currency war for the last 3 to 4 years, as every country has tried to debase its currency, except for the Europeans, which are, there's a lot of contention between the northern, European Protestant countries and the southern Europeans. So based on that, going forward, there's been a huge amount of excess liquidity in the system. Across, the Japanese have turned the taps on. Even the Europeans now are trying to create excess liquidity. The problem is not the liquidity. There's no constraint. The liquidity is not the issue. The problem is the velocity of money. The problem is that there's not enough capex. There's not enough spending. All the corporates that we see that are beating their earnings estimates are doing so by cutting costs, not by growing their revenues. So there's been a global growth problem rather than a liquidity problem. So that's the first theme going forward. You've got to take a view that interest rates have been unnaturally low. The yield curve is extremely flat, and at some point it will start normalizing. But with the dollar being this strong, to compensate for that, bond yields have to keep dropping in America. And whilst that's happening, that being the base for the rest of the world, global yields are going to continue to be under pressure, which means that there's no such thing as tapering or tightening coming anytime soon, probably until the middle of 2016. This does bode well for risk assets, but it's liquidity driven. So you always need to be aware that at some point when the temper, what they call it, the taper tantrum will come back again, and you will see a massive risk off when the perception that inflation is coming back into the system. What we see though is the threat of deflation rather than inflation as commodity prices remain under pressure with a strong dollar. And then you take a look at the demand side. China is slowing. They're managing their property bubble. This is another big theme globally. The biggest demand for commodities comes from China, and they've been under pressure for quite a while. They are deflating their property bubble. They are deflating their commodity bubble. They're trying to get rid of the shadow banking system. And then you look at the supply side, which is all the global miners and the oil producers, and they're in a rush now as they see this deflationary environment to hurry up and drive volumes to push down their cost curves and force the higher cost producers out. So you've got falling demand, rising supply, a rampant dollar, and that doesn't bode well for commodities. So the theme is going to continue to be deflation, easy and cheap money, excessive leverage building up in the system once again. And you must bear in mind, it's been 6 to 7 years, going on 7 years now, where we haven't had a real correction. We had almost a 20% correction in 2012, but I think that was, it was very much knee-jerk driven rather than fundamental driven. And every decade you tend to have a major correction, be it in the 87, the 98, 2002, 2008. We are due another correction in the next 2 to 3 years, and I think Warren Buffett says a rising tide lifts all boats, but when that tide goes out, you'll see who's swimming without swimming trunks. And I think you need to be very aware that there's a lot of beta dressed up as alpha in the market at the moment, which it's not. And the real money is going to be made, I think, in the next few years on the short side. People have the ability to identify shorts, which is going to be macro-driven once again by the likes of the dollar, China, the commodity story. The geopolitical risk in the world has risen dramatically, but people are focusing on the likes of ISIS in the Middle East, the civil war that's going on there at the moment between the Shias and the Sunnis. The reality is what's happening between China and Hong Kong is a lot more delicate and a lot more dangerous and more important for the global economy. The world is definitely split between capitalism and communism. And if you remember in this presentation I showed recently, is that inverted pyramid with the Gini coefficient. If you take a look at who's at the top of the pyramid, the haves we call them, it's the Europeans, it's the Japanese, the Australians, the Americans, places where capitalism has been allowed to flourish, where innovation has been encouraged, where entrepreneurial risk-taking activity has been encouraged. If you take a look who's at the bottom of the pyramid, it's the communists. It's the communist countries, the likes of the Russia, the China, the India, etc., where unfortunately free market entrepreneurial activity was not encouraged. South Africa's moved into that camp. We've definitely moved closer to the left than we should have. After Polokwane in 2011, we started increasing social grants, creating more of a social welfare type state, and now we've been rebuffing advances out of the Europeans, particularly the British and the Americans, and focusing on building relations more with the Russians and the Chinese, signing nuclear deals, etc. This, for me, as an investor going forward, is one of the reasons why we remain bullish. South African companies, which are very well managed and able to operate in chaos. South African companies traditionally, if they go into developed world markets, like the UK, like Australia, like America, when there's competition and regulation, they battle. Most of them have in fact come back with their tails between their legs. But South African companies, because they were forged during times of excessive chaos, in the years from the 60s onwards, and the years of sanctions, these companies understand how to operate in informal economies. The SAB Millers, the Anglo-Americans, the British American Tobaccos, the Naspers, the Richmonds, they understand how to operate in informal economies and how to formalize them. So we remain long those companies, but we're still quite nervous about being long South Africa incorporated, meaning manufacturing and deep level mining locally. So I think those are the major macro themes. In terms of our other theme we spoke about during the conference, continued urbanization, the rise of the emerging market consumer. We do prefer to sit on the supply side, so to speak, in terms of companies that are not taking credit risk, not taking execution risk. Like I said, it's not relevant to us whether Carrefour or Lidl or Walmart or ShopRite or Tesco's or Sainsbury's wins the retail race in the emerging market. We prefer to be the companies that supply, to sit in the companies that supply all of them with similar products. And that's kind of how we like to play that theme going forward. We play the theme of rates being lower for longer and this excess liquidity. We play that by holding US banks. We hold Goldman's and another bank. And obviously there's still that recovery in the US property market. The mortgage-backed securities continue to trade well. And our overall overarching theme going forward is to remain neutral to short on the cyclical counters, and we prefer to be long within the defensives that are still paying, because fundamentally your dividend discount models have changed. Interest rates are the lowest they've ever been and are going to continue to stay this low. The world will continue, as deflation becomes more of a threat, all that's going to happen is you'll see increased stimulus and increasingly trying to get investors out of the risk-free assets into more risky assets, banks to take more risk, and that eventually will stimulate another capex cycle and demand. But that's probably 3 to 4 years away. In between that, we're going to see another real risk-off environment. I don't know if it'll be in equities. I think it probably would be in bonds, which are starting to look like they're going into bubble territory.